Hello, welcome to It's Your Smarter Money with Dr. Laura and Professor Steve. Today, we want to talk about something a little bit different, although we've alluded to it many times, and that is the investor's dilemma. Right now, what we've been seeing and what we continue to see when clients come in to meet with us for the first time is that most investors have their portfolios situated where they're dominated by two primary asset classes: domestic large cap stock and bonds. So they have the risky and they have the safe. And
Right.
this traditional type of portfolio is often called a 60-40 portfolio. It's kind of an old, kind of traditional standard way of looking at a portfolio. And it's been fine for many, many years. It performed well in the past 10 years. The prior 10 years, it did not. From 2000 to 2010, it did not. But for quite some time, it was performing fairly satisfactorily. And a lot of that has to do with the interest rate environment.
In fact, if you go to Vanguard's website, you'll see they have a 60-40 there. And I think it's averaged, I think around 8% a year since 1980. And that date is very selective. If you choose that date, the 60-40 looks quite good. I think if you go back much further, it doesn't look quite as good. And we'll show you why.
Yeah.
And why it's not going to look very good going forward.
Right. So the thing is that if you really look at this slide, this tells a lot of the story here. It shows how interest rates had climbed from the mid 60s up through the 80s and then started to decline. And okay, so why do we care? Well, first of all, in the declining part for the past 40 years or so, we've had the benefit of having declining interest rates, which have increased the value of bonds and has added to the overall performance of a 60-40 portfolio. But that period from the 60s to the 80s, that was not a good period. Investors did not do well. From everything that we've seen, if they're lucky, if they would have gotten maybe a 1% return over that period of time. And that was because they were climbing these interest rates. And unfortunately, stock prices are affected by interest rates as well.
They are. Yeah. And if you locked in a 30-year bond in 1980, your return, you might have, especially with Treasury, 30-year Treasury in 1980, you could have beaten probably the stock market over the next 30 years with the interest rates that were in existence at that point in time.
So that chart, I should just mention that chart ends at 2015.
Yeah.
It's only gotten worse in the past 5 years, 6 years. Right now, we're at all-time lows across the entire world, not just in the US, where short-term rates are even negative and long-term rates are definitely the lowest they've ever been. So it's hard to imagine that we potentially, this strategy of a 60-40 strategy could do well over the next 10 years.
Yeah, actually, Treasury rates, I have to look back on the chart, but I believe even going out to 10 years, if you factor inflation right now, which is exceeding 5%, the return is actually negative right now on Treasuries. So this is a real issue going forward. And so what it means is 40% of your 60-40 portfolio is not really going to be performing and really providing any real return, especially any return that's going to exceed inflation at this point.
And it's also going to be yanking equities down because the premium over the risk-free rate just isn't going to be there. And that's why a lot of people are projecting returns over the future 10 years as being much more dampened than they've been in the past. Yep. And this is the investor's dilemma. If you're going to continue to stick to the 60-40 strategy, you're going to potentially see some problems. And so we, of course, go back to the science because that's what Steve and I do. We're scientists and we believe in the science, and modern portfolio theory continues to offer us a tremendous opportunity to say, well, okay, in the theory, it does not say use traditional portfolios. It just says find asset classes that have negative correlations to each other and don't fully perform in the same patterns as each other. And so that's what we've done. And we've continued to do that over many, many years. And we will continue to do that because that's what works.
And what's surprising, we see a lot of advisors who don't believe in modern portfolio theory because they've experienced issues with it because I don't know they fully understand how to run an optimizer, which is the software used to create portfolios. There's a lack of understanding I've seen.
Well, they don't know how to run the optimizers. They don't know how to select investments that represent the input of the optimizers.
Yes.
And they don't stick with it long enough to give it the right the value that it brings to us. But it's worked continually. And this slide here actually is a recent study that showed the comparison of a 60-40 to if you just look at the middle one, let's just look at the middle one because that's the 60-40. The other groupings have the one on the right is more aggressive, the one on the left is more conservative, but the one in the middle is the 60-40, which is considered the middle of the road moderate type of portfolio. And it shows on this plane of risk on the bottom and return across the y-axis. And if you just think about it intuitively, you should probably think that, gee, risk, we want to be further to the left because that means less risk, and return, we want to be further high up because that means more return. And what it shows is taking a 60-40 portfolio and just breaking it down into a 30% US stock, 30% fixed income, and 30% other alternative asset classes, we call them enhancers, will actually reduce your risk and improve return at the same time.
And that's really critical because reducing risk also reduces something which we call a risk tax or risk drag. I think we can probably cover that in another video as well. We're probably going to do a video on different metrics for measuring risk.
Right. But the economists the universal view of modern portfolio theory is that when people come to us and they say, I want more return and less risk, a lot of professionals will just kind of laugh to themselves and say, well, wouldn't we all? But the truth is that with modern portfolio theory and these scientific techniques to reduce risk and increase performance, this is actually our only free lunch. And that's a term that the economists use. Modern portfolio theory is, in fact, a free lunch. We can get our cake and eat it too.
And like you said, most finance professors say it's the only free lunch in the world of investing. So,
so if you've looked at your performance report lately, you probably will notice that in one of the earlier pages of the portfolio, we show you that your portfolio is broken down. And this is kind of a pretty much
Laura made us rename them.
I'm sorry?
Laura made us rename the categories.
Well, just group them so that people understood what we're doing, because we know what we're doing, but we want to make sure you understand what we're doing, because the more you understand, hopefully the more peace of mind you're going to have, the more you're going to understand that this is not just us picking things willy-nilly, that we have a method to our madness. And so this is the example of what a 60-40 portfolio really should be converted into, where you have your growth, which includes all your US equity, large cap, mid cap, small cap, international large cap, and also international small cap. We have our stability, which is our bonds, which are quite a challenge these days, finding bonds that actually can give us a decent return. But this is the pool of investments that we expect to not move too much. If you need money and the market's just not doing well, this is where we're going to go to source your funds. So we want to make sure that we have a strong offering in that area as well. And it's also negatively correlated to the US stock market. So we're getting that effect of negative correlation. It's these
That's correct.
enhancers that are really giving us a little bit of the best of both worlds, where we're looking for asset classes that are negatively correlated with both the equity, the growth piece, and the bond piece, but also have some upside potential for return.
Yeah, I don't want to mention the stability piece. We only buy the safest bonds there because study after study has shown that corporate bonds, for example, will decline in a bad market, and that's why we don't use corporates. We've mentioned that many, many times in these videos.
And we've not just seen it in the studies, we've seen it in real life. In
In real life.
2008,
Yeah.
when everybody said everything went down, they're right if they had less than investment grade bonds.
That's correct. Yep.
So this is our portfolios in general. Every client
Asset classes, yes.
yes. Every client in our firm has all of these asset classes in their portfolio, unless there's some kind of odd nuance, and you know who you are if you have that. And this is actually the year-to-date performance as of, I believe it was maybe yesterday or the day before, where right now it's October 27th of 2021. And you can see that, yes, the US stock market has done well. And so when we combine all of our growth asset classes, we've achieved a good return. You can see the challenge that we have in the particularly international bonds, but also our individual bonds. But the enhancer asset classes, where we're looking for that diversification, that lower risk, we've still received some tremendous performance year to date.
Yeah. And we're starting to see the effect of high inflation on the natural resources asset class. And it actually does positively affect the real estate asset class as well. Both respond well to bouts of high inflation, which is why we've actually always held those asset classes in part. Plus, also real estate's had a very high return going back from the time I began to use, which is again 1995. It's always been a great performing asset class. Natural resources, not always so much. I mean, there have been 4 or 5 year periods where natural resources performed poorly because there was no inflation and there was huge supplies of various commodities. In many cases, the supplies exceeded demand, so we didn't see it perform well. But suddenly now with natural resources, we're seeing the 7-year, 5-year average return back up to about 7% over the last 5 years. That's annualized.
So these are actually all of our asset classes that the performance of the actual holdings that we have and how they've rolled up. You can drill down and actually look at how the individual security selections have performed. When you net these all together based upon a weighted portfolio, depending upon whether you're a conservative investor or aggressive investor, you can you'll see a variety of different performances, but some of our portfolios are nearing and close to what you could have been if you were just in the US stock market, but with like half of the risk associated with the US stock market, or even less. So that's the name of the game, is not just are you getting a good return, but with what level of risk are you getting it?
That's right.
And this just shows $10,000 invested in the beginning of the year in this portfolio, this 1/3, 1/3, 1/3, where you'd be right now. And so it shows about I think a 12% growth actually.
Yeah, which is quite good, actually.
For a nice conservative portfolio. So, we continue to monitor the enhancer asset classes that we currently are holding, and we continue to look for other enhancer asset classes that can also offer reduced risk, negative correlation, not just from the US market or international market or bonds, but also from all the other asset classes that we're using too. So we want to test, we want to find those unique risk characteristics that we don't have represented in our portfolio. And we found these two asset classes a while ago. We were monitoring it. We've been using it in some people's portfolios, and we're starting to introduce them into other people's portfolios as well. However, we always want to make sure that people understand what we're getting them into. And
Yes.
these asset classes, these two that we're using two funds that are what they call interval funds.
Yes. And by the way,
Interval
these are
funds have
both,
some limitations.
yes, they're both really unique funds, and they're only really available to investment advisors for the most part. You can get into the private equity fund, I think, as an individual, but
But with the
minimum is
load
quite
and a high expense.
Yeah, very high. And the other one, Lendex, is only available through an investment advisor. And what happens is sometimes we can gain access to an asset class we couldn't efficiently invest in the past. And we keep our eyes out for that type of thing. And so we can enhance the efficiency of a portfolio by gaining access to an asset class that improves its efficiency and gain access in a cost-efficient fashion. We will do it. And we're going to talk about what it means to be an interval fund, I think, next. Right, Laura?
Well, we should probably just talk about it now. I mean,
Yes.
the thing about interval funds, the really positive thing is that I should never say never, right? The way we feel about investing is that you should always be invested in publicly traded investments that went through the entire disclosure, transparency process of filing with the SEC. And so part of the reason why we don't like things like emerging markets, because they lack disclosure and transparency. This is
Private
something
REITs.
that something that's really important to us is that it needs to be publicly traded, and you need to have access to it fairly often. And that fairly often piece is what's unique about these investments versus our other investments, because all of our other investments, if you call us today and you say, I need all of my money today or within the next couple of days, we can execute trades and get you all of your money within a couple of days. These two funds, not so, because of the interval nature. Do you want to explain that?
Yeah, and so the way it works is this: these two funds, they are registered under the 1940 Securities Act. I remember the exact name for it, but they're both registered as mutual funds. They have daily purchase liquidity, but they have restricted selling liquidity. They'll never liquidate, and there's a reason for that, which I'll explain in a minute. They'll never liquidate more than 5% of the fund, the outstanding shares in any quarter, any 3-month period. And the reason for that is because of the nature of their investments. Lendex holds actually individual loans behind it, and they're on higher FICO score rated people, 650 range, I believe. And so they also hold small business loans, and also some student loans. And so they don't have immediate liquidity on these loans. Now, I believe the average duration is 3 to 4 years on these loans, but if they certainly had a request of 50% liquidation on the fund, they would have to sell, or somehow liquidate those loans by probably selling them to someone else, and at probably fire sale prices. So it would not be really good for the fund, and it also would not be very good for the shareholders left behind who didn't sell. And so, and a similar thing with the private equity fund, which actually invests in companies before they've gone public. It's pre-IPO companies. And once again, there's limited liquidity there. So if we get a request, for argument's sake, to liquidate X number of shares, and they haven't hit that 5% level for the total liquidation of the fund in that quarter, we can sell all the shares. But if they have hit that 5% limit, what they're going to do is they're going to allocate it across all of the requests, and we're just going to have to get an allocation of the amount of shares that will allow us to liquidate. So there are these liquidity restrictions on these funds.
It's because they want to unravel slowly, and it's not too unsimilar to how we like to invest in domestic bonds. As you know, we like to buy individual pieces, individual bonds, as opposed to getting a bond fund, because we have control over when we're going to sell it, and we can sell it when we think that the market is right, or we can hold it to maturity. It's somewhat similar to that in this arena. What's particularly nice about these funds versus if you were going to get these funds in the private arena, which is where you used to be able to only get access to these kinds of investments, would be in the private arena. In a private arena, they're usually high minimums. They're usually very onerous reporting.
Very illiquid, very illiquid.
They usually have K1s, which are this whole nightmare process with accountants trying to document what your tax situation is. Here, you're going to get a 1099 reporting. It's not going to create any kind of problem. We have lower minimums and ability to actually get exposure to them. So there's a lot of benefits to them being publicly traded.
Yeah, and we've seen some advisors who will use non-liquid investments. Now, these are relatively liquid, as we mentioned. And, you know, our view is this: if you're going to, for example, buy a private REIT, right off the bat, it has to provide 2 or 3 or 4% more return than a real estate mutual fund that's liquid, because you need to get a premium for illiquidity. And I've seen in the past where I don't think advisors are getting that, you know, and for some reason they're okay with that.
Well, you also should get a premium for the trust factor, because you have to trust that they're doing the right thing, because they're not required to disclose. You have no idea what they're doing.
That's correct. Yep.
So this chart just shows the performance of Lendex, which is the alternative lending fund that we've selected. Again, it's only available to institutional investors or registered investment advisors that meet certain qualifications in terms of education and so forth. The fund buys consumer, small business, and student loans. They look for high quality borrowers, people with FICO scores of over 700, and they have a whole process on how they do their due diligence in selecting their funds. And it's been a good performer. I think our expectation around this fund is that it would deliver somewhere around a 6% return. Is that what we have in the model, Steve? Okay, so clearly this past year it's outperforms. And I don't know if you want to explain why.
That's a one-off, and don't expect that going forward. So what happens is, for them to gain access to some of these small business loans, they get access through platforms like Lending Tree and Square. If you haven't heard of Square, Square is a platform that allows small companies to process credit cards. And so these companies, they have pretty good access or insight into the cash flow of the companies that use them, these small businesses. And so they'll offer them small loans, 10 or 15,000. And it's hard to find those small loans at banks any longer. It's just not efficient for them. Whereas these platforms, right off the bat, they have a pretty good metrics on these companies that are using the platform. And so for Lendex to get access to at least, I believe, 1 or 2 of these platforms, they had to make an equity investment in the platform. I think 3 to 5 years ago, it might have been. And so that, I would call it it was a private equity. It was a pre-IPO investment. Now, I don't know which platform it was offhand. They've probably told us, I don't recall. But it went public, and Lendex profited enormously from it. But we do not expect that to happen going forward.
Yeah, it
we
was SoFi and Upstart.
Thank you. All right, you found out. Thank you for that. Okay. Yeah, and so we don't expect that going forward. We expect a 6 to 8% return probably per year in this fund. But those who are in it, boy, they sure benefited.
Right. So we're still anticipating more of a 6 to 8% return, which is clearly much more than what we're getting from the bond world. Yep. And you know, really the reason for that is that these are individuals that are they're looking for financing that they're not able to get through the normal banking channels. The really interesting thing is, though, that the sources of the funds are coming from primarily the banking channels, as well as asset managers and insurance companies. So the sourcing is coming from the same place, but it's just an efficiency methodology for them to actually get the financing.
And so why do we like this asset class besides the return? It also has a really low correlation with almost anything else, which means it improves portfolio efficiency. That's the other reason why we like this asset class a lot.
Well,
And it is a
source
one-off
of risk.
with that. Yeah,
The
it's a
source of
different
risk
source
is
of
not
risk.
interest
Yeah.
rate risk.
Yep.
The source of risk is probably something more around unemployment.
Yes, it is. Exactly. And that's what we believe. It's probably around unemployment. And I will say this, it hasn't gone through a real test like a year like 2008. It had a partial test last year when COVID hit, when the market was down about 30% from, I guess, from February till around the end of March in 2020. The fund was down about 4%, but it quickly recovered. And I think it was down 4% more because there was a feeling that because of what happened is a lot of people lost their jobs, that it might have been a higher rate of defaults. But apparently they didn't really see that, and the fund bounced back relatively quickly. So
Because it's the people that are borrowing are strong borrowers.
yes.
They really target individuals that have a strong backing,
That's right.
and that helps.
Yep, absolutely.
Steve, I'm sorry if you could go back just so people
Yeah,
know.
sure.
The comparison here, the LBUSTRUU
That's the
is
Barclays aggregate, right?
Barclays
Yeah.
aggregate. So it's a
I memorized that
representation
symbol.
of fixed income, fixed income. And the one to the right, the LMBITR is municipals. And so you can see how they performed over the past year or past 5 years. Not as well.
Yeah. But like we've said, don't expect that 37% going forward.
Yeah,
6 to 8, 6 to 8. Stay focused on that.
right.
Go-
So private
go ahead, Lord.
shares, the private share fund is another really interesting fund that was launched back in it was the A share was launched 2014, I think it was.
Yeah,
So
it might have been. Yeah.
They
Yeah.
even have history of investing. This management team has been doing investments in the private arena for
Yes.
much longer. They issued out the institutional share within the past couple of years. And of course, the institutional share is much better because we get reduced pricing. We don't have front loads. We don't have we're able to get a reduction in the expense ratio. So it's nice. What they're doing is they're investing in small businesses or private businesses that are not yet on the public exchanges, although the fund is on the public exchange.
Yes. Yes. They're pre-public firms, and just to throw out one name that they've invested in, I think it's their third largest holding now, maybe fourth, is SpaceX. So if anybody's interested in space, this is the fun to be in.
Yeah.
And by the way, I think last week or the week before, they said that the valuation of SpaceX now went up about 25 billion. They value it around 100 billion now, SpaceX, because he once again, he's a disruptor. He's disrupting different markets. Yeah.
Absolutely. And that's a lot of these investments will be market disruptors. They're generally late stage VC backed, venture capital backed companies that have, in fact, will tend to have better return than if you actually wanted to invest in an IPO. I know a lot of clients have come to us at different times and asked us, should I invest in the new Twitter IPO? Should I invest in the new Alibaba IPO? And usually what you're doing is you're catching it after it's had a nice run.
Yeah.
To be able to be in the investment prior to that IPO, those are the folks that are going to get the benefit of the future of that business. That's
correct. Yep. So here that you've kind of put down the different stages of private equity, right?
Yeah. So they don't focus on any of these early stages. If a company is looking for financing, they haven't even demonstrated that they have a good revenue stream. They haven't really demonstrated their value yet. That's not who these folks are investing in. They're investing in those later stage companies that are getting ready to actually potentially turn. And that's why this particular fund is very exciting. The projections of what this fund is potentially going to deliver are quite high. I don't know what we're using in our optimizers, Steve, when we're thinking about it, but I know you're not using what they're projecting. You're
No,
you
we're
always
not.
take a conservative view.
Yes. Yeah, and I estimate long term that its return will probably be 2 or 3% higher than the small cap asset class. But of course, like every other asset class, we're reducing our projection going forward because of the valuation of the markets. But in the long run, I think it'd probably be 2-3% a year higher than small cap as an asset class. So. Yeah, and of course, what's nice about it, and some of this I will mention is somewhat artificial because with private shares, they have to sort of estimate what the value of their holdings are, and I've met with the manager of the fund, and so they use various financial metrics to estimate the value of their holdings because they're not public, so it's not as if you can look up a stock price and say that's the value of it, and so they use various metrics and they compare it to other similar types of companies, and they look at their balance sheet and so forth and so on to try to come up with an estimate. And so because of that, you'll see that the price doesn't vary that much from month to month, whereas reality is probably is somewhat more volatile than that price would indicate. But also the correlation is somewhat lower than other asset classes, and some of that may be partially artificial, but we still believe that it definitely has a lower correlation with other asset classes. It's just a different asset class. And most people in the profession view private equity as a separate asset class.
So just to read this chart, again, we're going to stay just on that first left-hand column, which is the ticker signal for the private equity fund, PRIVX. And you can see it's 100% correlated with itself, the first row. But when we start going down the line and looking at, okay, NASDAQ, which is primarily technology, Russell 2000, the S&P 500, which are both stock market metrics, you can see that very, very low correlation. 0.2 is a very low correlation. And compared to the bonds, it's even negatively correlated, which is ideal.
Which is fantastic, yes.
Yeah. All right. So both Lendex and the private equity fund offer diversification to help protect our clients' portfolios against risk. Again, we've done extensive research on these two funds. We have begun to add them to some of our client portfolios. When we discuss it with each client, we're asking you to actually sign a document saying that you understand the liquidity restrictions, because there could be a potential time where we have to say, you know what, you can have everything else, but this we're going to have to wait. So we want to make sure that you understand that. If we have not talked to you about these two funds to date, please feel free to have a conversation with us at your next quarterly meeting. We're happy to explain to you how that would affect you personally and whether it makes sense for you personally. So thank you again for listening to our video, and we hope to see you soon. Bye.